estate is a big topic in Canada. Rentals, leasing, and general real estate activities make up about 13% of our country's GDP. So the stakes are high.
We're investing in a country, Canada, with phenomenal demographics. We've got population growth, and more people need more everything, a place to work, live, shop, and play. We've got a resource bounty that is almost unique in the world. On top of that, we have a world-class banking system. And in real estate, that is critical. All of this puts together is a phenomenal background for real estate.
I'm Alex Abjek. On this episode of Absolute Returns, we're talking about large-scale real estate investing with one of the biggest names in the industry, Jon Love, founder and CEO of KingSett Capital. Welcome to Absolute Returns.
Check up on the health of the office sector. The issues that they've been facing have been pretty well telegraphed.
If you're in the market for a new place to live, this could sting. Homes are more expensive than ever before in Calgary.
Toronto's condo developers apparently just saw sales of new units fall to the slowest pace in 27 years.
Real estate takes up a lot of space in our news headlines. For many of us, when we talk about real estate, we're talking about the cost of housing. But for institutional investors, there's more to consider, like retail buildings, industrial space, data centers, and office towers, and how they're occupied. Because COVID started a new era of work from home and hybrid work, and a lot of other factors have changed since then too. Interest rates began to rise, population growth accelerated, and more recently, there's been a slower market for large building sales in Canada. To sort through all of these issues, I spoke to Jon Love, CEO of KingSett Capital, the country's leading private equity real estate firm, and Paul Mouchakkaa, Executive Managing Director, Global Head of Real Estate at AIMCo. I started off by asking Jon how his job and the industry are different today compared to pre-pandemic times.
I would say most of the headlines that you read are more sensational than the reality on the ground. I mean, the fact is that on the operating side of the business, the operating side is pretty good. You know, we're leasing space, buildings are well leased, tenants are paying rent, life goes on. Now, in the office sector, which I'm sure we'll cover, there's some nuances about where you are and what you're doing. But by and large, markets are actually pretty good on an operating side. On the capital side, the investment market is very slow, which is not to be unexpected after having such an increase in interest rates and, what could be a potential recession or soft landing or what have you. So those markets are quite slow, where they move from FOMO to fold, the fear of missing out, to the fear of looking dumb. So they're on pause.
And when you say on the capital sale side, that's just referring to the deal flow that's happening in terms of sales of buildings.
Correct. Well, purchase, sales, et cetera, is just quiet out there at the moment.
And Paul, what about you? What do you think about how this world is and how your job has maybe changed or not compared to 4 years ago?
Well, there are some things that are just fundamentally the same. And there are kind of four ways you have challenges in real estate. And it really is determined by your behavior in the late part of the cycle. And the four sins that you can commit in the late part of a cycle is you chase yield, you juice up your leverage, you increase your pacing, and you give on governance just for that FOMO that Jon was talking about. And if you avoid those sins or any, especially all four of them, then you'll be in a much stronger position. And so from our perspective, that's, our job. And so we're very focused on making sure that we're very consistent and clear in terms of our strategy. And as you think about whether you're pre-COVID or you're post-COVID, those elements still matter. And what's really the bottom line today is you were in a situation pre-COVID where a lot of your performance could be determined by, compression in cap rates. It's now going to be an operating driven return. And so it's going to come down to how well you manage and operate your assets and deliver on the bottom line.
When you talk about being late in the cycle, can you just sort of explain that a little bit more, what you mean by that timing?
Yeah, I mean, really, mid 2022 was very clear. When interest rates went up, real estate market has really slowed down, and from the commercial real estate market has really slowed down. And so we're really in a position now that we're in a capital market recession today. But a lot of the operating fundamentals, particularly in Canada, are quite strong. And I was asked recently by our board chair, what surprised you over the last 12 months? And one of the things I said to him was that the operating statistics across three of the four main sectors, being apartments, industrial, and retail, all performed better than they did in 2023 than they did in 2022. The only exception was the office sector.
And if you could talk to the Paul of 2020 with the insights that you have now as the Paul of 2024, what do you think you would have told him?
Yeah, I mean, again, don't make any of those four sins. That's always been a mantra of mine for many, many years, for almost 15 years. And if I had to pick something, it would be really pay more attention to the underwriting assumptions in the models in 2020.
Jon, what about you? If you could go back and talk to yourself 4 years ago, is there any words of wisdom or calm that you might give yourself from back then?
I think if someone had said to me pre-COVID that over the next 3 or 4 years, you would have the following: you'd have all your properties locked down. Everybody would be locked down on their home. That interest rates would go from 2 to 7. I mean, you'd sort of say, well, that's a pretty startling set of facts. And so we had a black swan, which is something in my 45-year career I've never experienced. I've experienced operating recessions. So let me tell you, that's a whole different story. But this is a capital recession.
A couple of things that I want to touch on there. I mean, if you had to pick between the two, between an operating or a capital recession, which one is easier to ride out and why?
Hands down, a capital recession is easier to ride out than an operating recession. Let me give you a sense, because many young people don't understand, what a difficult period looks like. 1989, downtown office, Class A building, a joint venture with AIMCo. And I should just say we've been joint venture partners since 1984. So we've got 40 years of experience working together. On this project, in fall of 89, leasing space at $36 a foot. In the spring of 91, 18 months later, it was $3 a foot. That creates all sorts of crises. So that's not where we are. Today, take Scotia Plaza, which is a project that we co-own with AIMCo. It's AAA downtown Toronto. And if we look at the rents today, are 20+% higher than the rents were pre-COVID.
1989 Edmonton, that's kind of when you were really starting your career in the 1980s in Edmonton with Oxford Properties. Is that right, Jon?
Actually, I started my career with Oxford in 1980, but the 80s saw quite a boom everywhere, including in Edmonton. And then in both Toronto and in Edmonton, excess supply hit the market that created significant vacancy, and participants at the time were over-levered. Equity was non-existent, and there wasn't the capacity to absorb any changes. And so therefore, there was kind of panic selling. There are some parallels to what you're seeing in the US. And when we look at our markets today, it's totally different than what you see in the US, because there's no distress in Canada. There's no forced selling. Major assets are all owned by well-capitalized, sophisticated investors such as AIMCo and ourselves. And people are riding it out and doing all the things that Paul was talking about, which is basics of leasing space, trying to create a more compelling offering to the customer, et cetera, et cetera. But we are in a capital recession because money's not moving. But the more important part is the operating strength of the four asset classes, including office.
You mentioned their excess supply. We do know that there has been a shift with more people working from home and more hybrid work schedules that people are adopting. There is excess supply in the office market, would you say?
You'll see in the US primarily, especially in competitive industries like finance in New York, people are back 5 days a week. So, I mean, ultimately where the model is going in Canada, because we have less competitive economy, but where it's going is 3-4 days, maybe some will be 5. People want their people together to learn, to collaborate, et cetera. And so the office footprints aren't shrinking, or what's changing is what tenants are looking for. Because AAA buildings have a good bid. But if you're isolated, non-transit, you're not strategy forward, so on and so forth, they're suffering. Is there some reduction in demand at the margin? Yes. I mean, so there's some extra vacancy. But that actually is not the story. The story is how selective tenants are being and what they want. And what they want is super urban, on transit, amenitized, and strategy forward, all the way from, zero carbon strategies that we have to other things that make their buildings more competitive and more compelling for both their employees, but also the productivity of their business.
I want to break in here for a moment. Jon Love just mentioned the robust return to office that's happened in places like New York. But you don't have to go that far to see buildings that are equally busy. I recently met Doug Brunsdon outside 8th Avenue Place in Calgary. Doug is a portfolio manager at AIMCo in charge of Canadian office real estate. AIMCo co-owns 8th Avenue Place along with partners Ivanhoe Cambridge and Mouchakkaa Investments.
We are in what I would call the downtown central business district of Calgary, right in the downtown heart of all the office nodes. If you were to look south, you would see the tracks and the city. If you were to look to the west, when we get up in the tower, you'll have some uninterrupted views of the beautiful Rocky Mountains to the west. To the north, you'll just see the downtown central business district. This building is approximately 1,935,000 square feet over the two towers and the retail. And if you'll follow me, I'm going to take you over and introduce you to one of our famous concierges.
Hi, I'm Mark Mendioro. I am the corporate concierge at 8th Avenue Place, and I take care of the West Tower.
Mark is actually one of the building amenities that we're very proud of at 8th Avenue Place. He will help you with anything you need to know about the building, anything you need to know about the location, and anything you need to know of what's happening in the city and maybe even how to get tickets. Except Taylor Swift is sold out. I'm so sorry about that. Yeah.
Yes, Taylor Swift tickets are almost near to impossible to get, but I'll try my hardest.
I was going to ask, what's the most interesting or unique request that you've ever received?
Kentucky Derby tickets. But I became friends with one of the representatives from Kentucky, the Kentucky Derby, so I have her on speed dial. So if I need her for tickets for next year, I always have her on call. It's amazing.
So I'm going to get Mark to take us up and show us the world-class workout facilities that we have.
We get to the gym around noon on this Monday in August, and the space is packed.
So it is fairly busy. So if you want to get a quick tour, weight machines, your traditional, fitness center. Also behind me is group exercise Studio A. Everything from Pilates, yoga, HIIT classes. On the second floor here, the mezzanine, is cardio machines for everything from treadmills to ellipticals. Downstairs is another Studio B, which has bikes, so more for spin classes.
How important was it, or how much do you think it is important for a downtown office building to have a strong gym facility for office workers who are otherwise at their desks all day?
It's part of the lifestyle. If you want to be a top building, you have to offer top amenities in the market. So having a world-class open facility like this, it creates an environment where the staff coming back to the office can live, work, and play almost in the neighborhood. That includes amenity space like first-class workout facilities. It includes bike rooms where you can have storage of the bike rooms. It includes restaurants and coffee shops and some retail. So if you have a long, tough day at work and you realize, oh my goodness, I've got company coming for dinner, you can pop downstairs to a high-quality wine and liquor store that is in this building and pick up that bottle of wine that is going to go with that wonderful risotto you're making tonight.
One of the gems of 8th Avenue Place isn't just what's housed inside, but what's outside. After touring the building, Doug and I step into the courtyard with Mark. It's lunchtime on a warm summer day, and the space is filled with office workers taking a break, sitting on benches, or eating lunch at the outdoor tables.
We spend a phenomenal amount of time at work in our lives. And when you can create an environment like what we have at 8th Avenue Place, everything from Mark the concierge to the workout facilities to the restaurants to being able to go shopping to being able to get a haircut, I look around and I see people enjoying life. This is an extension of your life, and it's in the downtown core, and when you come into the office, this is appealing.
8th Avenue Place is flourishing. But there's no denying that the broader Calgary office sector is struggling. The current vacancy rate is about 30%. Returning to my conversation with John and Paul, I asked Paul about his outlook for the future of office space.
Well, at my own peril, I do respectfully disagree with parts of what Jon is saying. And I say that definitely at my own peril, given his deep and knowledgeable experience and wisdom. I think it's much more nuanced in the office space. There's certain activities or roles that I don't think are coming back to the office anytime soon. And those are primarily jobs related to finance, more like accounting, reporting, I think some HR and some consultancy type, and even some legal research type of roles that exist in cities like Toronto, Vancouver, or even in the United States that are, much more still geared to people who competitively within that labor pool want to work from home. And I think that creates, in addition to some of the demand challenges and supply challenges, Jon is right. For the AAA space, there's a bid and there's even high demand for it. But in the sort of middle grade office and below, there isn't much demand, and there is, in my opinion, too much of that space. And so I think given those issues, there's going to be some structural vacancy that will land within the office space. And I think that's going to stay within North America, primarily Europe and Asia. Asia, they can't work from home for all intents and purposes. And in Europe, it is a bit more driven to have people, again, going to the office. But in North America, I think we will see a higher structural vacancy than we did pre-COVID. And so I think will weigh on office values going forward. Sorry, Joe.
We're seeing this now, buildings in Toronto that are a bit off transit, they're a bit older, they're, as Paul would say, the middle or lower. They're being torn down and being replaced with residential. You see this at 350 Bloor, one of the Rogers buildings. You're seeing the application, the old Toronto Star building. And, that real estate will get reinvented to a higher and better use. So if you own that office building, it's actually a good outcome. We own an office building on Bay Street at 1235 Bay, across from the Four Seasons. 12-story office building, nondescript, but we got it rezoned for a 40-story apartment building. Now, obviously, the apartment density is worth much more than the office building before or after COVID. We'll be tearing that building down and replacing it with a 40-story best-in-class rental apartment building.
And it's interesting that you talk about that because I think, neighborhoods are always changing. Buildings can often change. The use of these buildings can often change. I want to ask about maybe uses that we're seeing come up more. There are things like data centers that are needed. Life sciences spaces is another use for buildings that are quite important places that we might not have had that same demand even 20 or 30 years ago. We think about those uses for building and we talk about real estate broadly. Maybe I'll put it to you first, Paul. Do you see opportunities with sort of emerging sectors that we didn't even think about some time ago?
Okay, well, there are some people that are maybe listening to this that were too young during the dot-com phase. But the dot-com or the internet, it revolutionized our lives. That we can say unequivocally in the year 2024. But who in the year 2000, 2001 thought to themselves, gee whiz, warehouses are the play or one of the major plays in the dot-com change? Not very many people, I know, because you didn't see massive amounts of investment pouring into warehouses. So finding out what is the root driver from AI is not going to be apparent to us today. Secondly, even if you made your bet in warehouses back in the year 2000, you were essentially wrong for 14 years. And not wrong to the point where maybe you didn't perform well, but you did not have this huge pop due to the internet. So how this plays out will take time. But a couple of root potential investment strategies in AI that we're looking at within our portfolio is number one, data centers. Of course, the need for power, the thirst for power, the amount of phones. I have 2 phones. I had 0 phones 12 years ago. Now I have 2. And I'm a late adopter type of person. And so you will see, I think, more demand for power. Another thing that AI does for us is it increases and exponentially improves computational power. And so one potential outcome from AI is, can it improve, let's say, FDA approvals or drug approvals for health reasons? And that could spur more research, more analytical work. So our view is the early indicators on AI, subject to more research and analysis, and it will take time, is that data centers and things like life science or creative space and real estate are going to be very interesting places in the coming years.
And I would add to this that you take life sciences specifically in Alberta, where we have 2 of the best research institutions around health science and creative sciences in the University of Alberta, the University of Calgary. That can be a very burgeoning and interesting place to invest in the future right here in our home province.
And Jon, what are your thoughts on that?
Well, I agree there's going to be obviously increased demand in both. The challenge from an investment perspective is whenever you build special, single purpose buildings, you're hostage to a much smaller market. I mean, our view, we're always seeking tenant liquidity. We're always seeking assets that have a high demand. We always assume the existing tenants go bankrupt, and if that happened, what do we do next? It's like the cold storage business, which isn't a very particularly sexy business, but it is special purpose warehousing that's been around for a very long time. But those are high cost, high rent, special purpose buildings. And it's the same challenge with life science and the data centers. And with all the technology advancements that we're going to see, and how does that impact, customer demand? So at the moment, both asset classes look interesting, but it's hard to know how technology might evolve that strategy.
I also wanted to ask about the Fairmont Royal York. So that wasn't a project where the building was taken down, but your company sort of spearheaded a massive transformation of that building in order to make it achieve a zero carbon building certification. Can you walk us a little bit through what it took to do that?
Yeah, so it starts with, we've had a major renovation of the building and really brought it up to phenomenal standard. And the project's doing super well. But I said to our internal team, our sustainability group, could you imagine a pathway to take a 90-year-old building and make it zero carbon operating? They went away 6 months, came back, and they said, I think there's a pathway. I think we can figure out the technology to do this. Now, it took 5 years, a lot of effort, $65 million, which was helped by the financing of the Canada Infrastructure Bank. But that process started with managing the load, used a Canadian startup called Circuit Meter that micromanaged all the loads so we could, in a very narrow sense, understand what we needed to replace, which was a lot less than what was there, because load management is key. Then it was deep water cooling, which is the Lake Ontario fed N-Wave program that allowed us to have basically it's a heat pump technology. Our source of energy is sustainable and comes from the lake. And then all you have to do is replace every other piece of mechanical equipment in the building. I mean, most of them were at the end of life and everything's been replaced. So it was a very big, ambitious project. But the outcome is remarkable. It's the only hotel in Canada, zero carbon. It's the largest hotel in the world, is zero carbon.
I'm assuming as well that there were some cost calculations that doing this would be worth it in the end. Can you walk us through sort of the rationale, not only just wanting to take on this giant project, but why?
All of our zero carbon strategy relies on an economic consequence, right? I mean, if we allocate capital to something and there's no return, then there's no reason to do it. So the finesse is to figuring out how to squeeze out that return. Now, in this particular case, where it was a very ambitious project, it was facilitated by Canada Infrastructure Bank's financing, which gives credit for your carbon reduction. So that credit to the interest rate for the carbon reduction made that capital expense all work. I mean, it will have the same amount of savings on utilities as if we went to a fossil fuel solution, gas-fired solution. But the premium to go to zero carbon was offset by the interest savings on the loan. And the other issue is we have now curtailed or managed our risk, our utility cost risk, commodity risk for a long time, and also carbon taxes and so on and so forth. So there's a lot of other risk management there. Now, we don't count a revenue response because we haven't seen a revenue response so far. But I think that, it's a question of time before we either see legislated requirements or we hopefully instead will see customers responding where they say, you know what, we want to get on the zero carbon bandwagon. At the moment, we haven't seen it because that bandwagon is too small. There's too few buildings. Downtown Toronto, including all the new buildings under construction, there's only 2 buildings that are zero carbon, our Scotia Plaza and our 100 Yonge. Even all the new buildings, it's all through gas-fired. So because the gas-fired technology is capital cost cheaper. But I think that is short-sighted because I think the long run, these are much better decisions and zero carbon is the way to go.
I was going to say, Paul, we were talking earlier about the idea of best-in-class buildings and the things that people are looking for, whether it's being close to transit, whether it's having amenities. How important also is it for potential tenants or potential investors to see a building with a low carbon footprint?
John's a little closer to the tenant markets than I am, but in general, the trend has been quite positive in terms of, what tenants are looking for. They want high quality space and they want clean space. And in many cases, particularly Fortune 500 companies with obviously the best credit ratings available, they have their constituents, their shareholders, which a lot of them are big institutions like ourselves at AIMCo, that are making sure that they are doing something about sustainability within their companies. But I want to just take a step back, if it's okay, Alex.
Please do, yes.
Real estate in general is a long-term asset class. So you can't really look at one, it's not the same as looking at what happened in the S&P this week or even this year. And it brings elements of the bond world where there's an income return, but also some of the stock world where you want appreciation over time. And so, at the nexus of this is exactly what Jon is talking about. You have to play defense and you have to play offense at the same time. You want to lean into opportunities that will bring sustainable and consistent growth and value over not 1 year or 2 years. It will show up more over 5 years. So when he talks about zero carbon in Scotia and the Royal York, these are examples of, they have to be economic in terms of how they drive those businesses or those buildings' performance, but they're all under the auspice of ensuring that there's greater appreciation, better positioning for that building and that property, not 1 or 2 years, but 5 or 10 years down the road. So you're balancing, playing the appropriate amount of defense in terms of making your building competitive and keeping up with trends, but also playing offense. And at the root of this is this idea you brought up earlier of repurposing buildings, but also improving their energy efficiency and improving their sustainability or carbon footprint. And that's exactly how we look at it. It has to have a return. It has to be economic. At the same time, we want to ensure that whatever building we're investing in, whether we're currently own it or we're about to buy it, it's still well-positioned 5 years down the road. And it's no different than your own house. If you don't keep your house clean and you're not keeping your house looking good, then it just takes time, sort of takes it out of you. It just erodes over time.
All right. And just to wrap up this conversation, you're both longtime players in this industry. You've seen a lot of changes over that time. I just want to ask, what's making you excited right now? Paul, I'll start with you.
I would say you came out of the global financial crisis in 2008, and the capital market environment at that time for real estate was extremely positive. Allocations going up, lending was loose, but the actual demographic story around real estate was okay. It wasn't bad, but it wasn't great. But the demographic story around real estate today is quite positive. We have housing shortages, not just in Canada that everyone's talking about pretty much every day, but in Western Europe, in the United States, and in Canada. Technology is opening the doors around data centers, life science, as we discussed. It still creates boom for e-commerce and industrial investing. And lastly, we have more spending on healthcare than we've ever had. And that I fully expect that healthcare spending will continue to go up, and that will create more investment in that space. So I'm quite positive in terms of the demographic story around real estate in the coming years.
And Jon Love, last word to you.
Well, people talk about their short-term anxiety and interest rates and so on and so forth. I just take a step backwards and say, let's take a bigger picture view here. We're investing in a country, Canada, with phenomenal demographics. We've got population growth, and more people need more everything, a place to work, live, shop, and play. We've got a resource bounty that is almost unique in the world. On top of that, we have a world-class banking system. And in real estate, that is critical. And our banking system is our secret weapon. It's stability, it's scale, and it's been phenomenal. Then we also have the Maple 8, some of the world's smartest, most sophisticated global investors, which obviously includes AIMCo. And all of this puts together is a phenomenal background for real estate. What's needed to succeed is a great operating strategy. Because capital market recession, that comes and goes, like whatever. But focus on the customer. Focus on how to make the asset more attractive to the customer. Focus on your equity partners, your lenders, the other stakeholders you have in your ecosystem. Because if you do that, this is a phenomenal place to invest.
That is a positive note to end on. Thank you so much for joining us, both Jon Love and Paul Mouchakkaa. That was my conversation with Jon Love, CEO and founder of KingSett Capital, and Paul Mouchakkaa, AIMCo's Managing Director and Global Head of Real Estate.
That's it for episode 3 of Absolute Returns. I'm Alex Abjek. Thank you for joining us. Absolute Returns is a podcast by the Alberta Investment Management Corporation. Don't forget to subscribe. You can find us on Apple Podcasts, Spotify, or wherever you get your podcasts. Until next time.